Okay, what's going on everyone? In this video, I'm going to be talking about the second part of the two-part series. We actually talked about the 6 criteria that we need in order to get the loan estimate started. That's going to be your name, your address, your social security number, the loan estimate, the subject property address, and your loan amount. So those are the 6 things that we need in order to start your loan estimate. So we did talk about your social security number before in the last video. Something that I didn't mention was that for your social security card, we don't actually need you to bring that in because we're not gonna make copies of it, we're not gonna, nothing. So something that we are going to need is your most recent non-expired government ID, which is either your driver's license, passport. You're gonna bring that in, we're gonna make copies of that. We're not gonna make copies of your social security card. Beside the social security card and the ID card, we did talk about your 2-year tax return. So if you are doing a W-2, 1120S, a K-1, we need 2 years worth of that, so you bring it in. But the part that I didn't cover was that you're gonna have to sign either on the first page or on the last page where it says signature, and if you don't have it signed, we're gonna need you to sign that eventually. Once you have your documents, you have it printed out, definitely just sign it at the end so that we can knock it out in the beginning. And the signature has to copy everything that you sign in any of these documents, has to copy what is on your government ID. So if it's not the same signature as that or something similar to that, then we will have to ask you, if you can sign it the way that it is on your ID, only because it's important for us to record what is legal. The other thing that I didn't mention about your 2 most recent pay stubs is that it has to equal up to 1 month. So I didn't mention the part where if you were paid weekly, that we need 4 of those pay stubs in order to equal up to 1 month, or if you get paid a salary, then we need 2 of those to equal up to 2 pay stubs. The other things that we're gonna need is your bank statements. So if you get quarterly, bring in your quarterly statement. If you have any mortgage statements, so if you own a mortgage, you own a house, we need you to bring those in. It mostly applies to refinances, but it definitely helps out so that when we pull up your social security number, we run the report, we have the credit report, you pay your $31 credit report fee, then we'll find it out there. But if you have all your documents early, it helps us move along the process a whole lot faster. Something that pops up quite often is that some people like to use nicknames, so try not to sign on the application your nickname. It has to be whatever name that's on your government ID should be what is on the loan application. And we need you to season the account. So what does seasoning an account mean? It means that if you have your 20% down, which is what we typically need for a conventional loan, if you have your 20% down, we need it to be in your bank, in your account for 2 months. And that will be considered as seasoning. Do not apply for more credit cards. Don't apply for an auto loan all of a sudden. Don't change your jobs. If you guys decide to change your jobs and you guys get a promotion, okay? If it's a promotion within the same industry that you're in, so let's say you are a business administration and then you switch over to construction, don't do that. It won't count for your 2-year work history. But if you guys are working as administration and then you get a pay raise as another administration, then we can still do that. It's going to be a little bit more, a little harder for most applicants. It might take a little bit longer, but it's doable so long as it's a promotion and going upwards, and it's within the same industry. Again, don't try to switch different jobs to different industries because it does prolong the application process. And for the subject property address, on the residential loan application itself, you can actually put TBD, because to be determined is okay, mostly because let's say, for example, you wanted to buy the first address that you put in there, but someone else bought it already, or someone else outbid you. Then at that point, the address doesn't matter because we're gonna buy another house. So lenders use a magic number. So when people are first applying for a mortgage, lenders wanna know how much you can afford. And so what they use is the 43% rule. So the maximum your debt can reach is 43%. Let's say you make $10,000 a month. So if you make $10,000 a month, 43% of that is $4,300. You cannot exceed $4,300 for your debt. And last but not least, we can receive gift funds. So like, let's say, for example, mom and dad wants to help out. with the 20% down payment, then they can bring in their money, we can accept it as a gift fund, and then we can put that towards your seasoned account for the 2 months. So once you have all of these documentations and you filled out sections 1 through 10, which is, on the residential loan application, there's gonna be 10 different sections. Most of it's gonna be your personal information, your financial information, the address that you want, basically just the normal stuff. If you have a co-borrower or co-signer, this is the time for you to put their information in as well. So all of it's gonna be covered inside of these 10 sections. Plus there's gonna be a whole bunch of other disclosures as well. Those disclosures depend on the type of lender that you're gonna have. For the most part, they're just gonna fully disclose everything that they have. They might have an FBA, which is an affiliated business. They might give you that disclosure. There's a whole bunch of disclosures out there, so it really depends on your situation. But for the most part, a loan estimate, a closing disclosure, if you are working with your real estate agent, they will give you a different type of disclosure because it's going to be real estate related and not mortgage related. This is just a general overview for part 2 of 1 for the entire loan application. And there's going to be another video that I'm going to be posting out as well, where we're going to be talking in depth about those 10 different sections. Those 10 different sections, I'm going to walk through them. I'm going to tell you what you can fill out, what you can't fill out, what you're going to walk through with the lender when you meet up with them in person. And once you finally get the pre-approval, then we can start shopping around the houses and see what we can work with the numbers that the lender give you. So hopefully it's a high number, and also something that you probably don't know about. Just because you're approved for a certain amount doesn't mean that they can't stretch it a little bit more, So let's say you're getting approved for $800,000. The lender might be able to stretch out that $800,000 to maybe $820,000, maybe $830,000. Really depends on how the lender structured the loan for you. So there's a possibility for, just because you got approved for a certain amount means that you're stuck at that number. It's just that the lender could be able to work it a little bit more for you depending on the situation and the type of income that you have, whatever the lender has for your criteria. Just something to think about. So if you're stuck on numbers, don't worry about it too much. Just worry about what you think that you are able and ready to do. So once you submit in all of these documents, we're gonna try our best to work with whatever numbers that we can work with in order to get you your loan application approved so that you can get your pre-approval so that we can move on to the purchasing phase. So hopefully you guys like this video, and watch the next one where we go in depth with the entire loan application. I'll see you in the next one.